Hello everyone, this is Mario Giannakridis from Main Partner Trust. This webinar is about Cyprus corporate taxation and it is in the form of a case study with a practical example for ease of reference. Let us begin by examining how a Cypriot company is taxed. Now, a company managed and controlled in Cyprus is considered to be Cypriot tax resident, and as such is subject to tax in Cyprus on its worldwide income. But what this means is also that under certain conditions, some foreign companies may also be subject to Cyprus tax. In addition, as from 1st of January of this year, a company that was incorporated in Cyprus is again by default considered to be a Cypriot tax resident company and as such is subject to tax in Cyprus. Now, what kind of taxes may be applied to a Cypriot tax resident company? Well, first and foremost, we have the corporate income tax, which is 12.5% and is one of the lowest in the EU. This tax is applied on active sources of income resulting from the company's business. Apart from that, we have special defense contribution, which is usually taxed on passive sources of income, as we will see later on. We have capital gains tax, which applies on disposal of immovable property situated in Cyprus. And we also have value-added tax, which applies in certain cases. Now, moving on to our case study, we're going to make some assumptions for ease of reference. We are assuming that the company is a Cypriot tax resident company managed by an ASP. The shareholder of the company is a Russian physical person who is tax resident in Russia. The company's activities comprise of investing in assets and reinvesting. The assets of the company comprise of listed shares and bonds, as well as cash deposits with banks. And the company's funding comes from shareholders' capital contributions, loans from the shareholder, and also loans from the bank. We are assuming that the income of the company comprises of the following: coupons on the bonds, dividends on the shares, interest on bank deposits, and gains from disposal of shares or bonds. Like I said before, the company is financed both through capital contributions from the shareholder and also loans from the shareholder and loans from banks. On the expense side, we have fees paid to the custodian bank, fees on the external asset manager, fees paid to the ASP, fees paid to accountants and auditors, and we also have interest expenses on the bank loans. Moving on to the type of income and to see how it is taxed. The coupons on the bonds are subject to corporate income tax. They are subject to tax on a net basis. What this means is that one can deduct certain expenses that are allowed as tax deductible, as we will see later on. The company also has dividends on the shares, which as a rule are exempt from corporate income tax. It has interest on its bank deposits, which again are exempt from corporate income tax, but are subject to defense tax, as we will see. And it also has gains from the disposal of shares or the bonds. These are clearly exempt from corporate income tax. Like I said, the company is financed through capital contributions from the shareholder and from loans from the shareholder and the bank. These two are not subject to corporate income tax as they are of a capital nature and do not affect the income of the company. Moving on to the expense side, the general rule is that any expenses incurred wholly and exclusively for the production of taxable income are allowed as tax deductible. In most cases, a company may incur expenses that cannot clearly be attributed to a specific source of income. For example, in this case, we have fees paid to the custodian bank, to the external manager, to the ASP, to the accountants, to the auditors. How do we apportion them between the taxable and the non-taxable income? Well, it is acceptable to use a percentage. So we take the percentage of taxable income over the entire income, and we apply this percentage to the general expenses in order to see how much of those expenses can be claimed as tax deductible. Now, as for the bank interest expense, for simplicity's sake, we have made the assumption that the bank loan was used entirely to purchase income-generating assets, the income of which the income is taxable, in this case the bonds. Therefore, in this case, we have the right to deduct the entire amount of the bank interest expense. Last but not least, we have what is called notional interest deduction. Like the word says, this is a notional deduction that can be claimed against the company's taxable income if that income is generated from the application of the new entity. What does this mean? Suppose that the shareholder injects, say, 1 million in equity into the company, and the company uses this equity to acquire an asset which generates taxable income. On that 1 million, it can apply a notional reference rate, and the result of that creates a notional expense which can be claimed against the taxable income generated by that asset. How do you calculate the reference rate? This is equal to the yield of the 10-year government bond of the country in which the new equity is invested, plus a margin of 5%. It could be the Cyprus rate, it could be some other country's rate. And finally, NID is restricted to 80% of the taxable profit which is generated from the application of that new equity. What this means is that the tax rate of 12.5% can be reduced to an effective tax rate which is much lower, and applying the 80% restriction, it can fall to as low as 2.5%. Before we move to our practical example, a few words about special defense contribution. This is applied on certain types of passive income, which are exempt from corporate income tax. The main examples are dividends or interest income. In the case of dividends, these are exempt both from corporate income tax and from defense if either of the following conditions applies. At least 50% of the activities of the dividend-paying company lead directly or indirectly to the generation of active income, or, if this does not apply, if the foreign tax burden of the dividend-paying company is equal to or greater than 6.25%, which is half of the corporate income tax rate of Cyprus. Now, in the unlikely case that none of those conditions apply, then that dividend income will be subject to defense tax at the rate of 17%. The other primary case is income coming from loans and bank deposits. This is subject to special defense contribution at the rate of 30%. Just to note that this would not apply on coupons from the bonds because those are considered to be active income, and as such, they are subject to corporate income tax, not to special defense tax. Just a word about capital gains tax. As I have mentioned, this is charged on gains arising from the sale of immovable property situated in Cyprus. Or it could apply if you sell shares of a company which owns immovable property in Cyprus, and the applicable rate is 20%. Gains from disposal are generally not subject to capital gains tax. In case of gains from disposal of shares, as I have mentioned earlier, this generally does not apply unless, of course, the company holds immovable property in Cyprus. And finally, VAT. This is imposed on the supply of goods and services in Cyprus, on the acquisition of goods from the EU, on services received from outside Cyprus, as well as on the importation of goods into Cyprus. Now, income arising from coupons on bonds, gains from the sale of shares, etc., is exempt from VAT. Therefore, in our example, VAT would not apply. Nevertheless, some investment companies may have an obligation to register for VAT in Cyprus. Why? Because of the services that they are receiving: asset management, custodian fees, ASP fees, etc. but each case needs to be examined separately and on its own merits in order to assess whether the company needs to be registered for VAT or not. Now let's move on to our practical example. We are assuming that the company has the following assets: bonds with a coupon rate of 5% equal to 3 million, listed shares equal to 1 million, and bank deposits equal to 2 million. The company is financed through a combination of equity and loans, specifically own equity of 1 million, interest-free loan from the shareholder of 3 million, and interest-bearing loan from the bank equal to 2 million. The company incurs on an annual basis coupons from the bonds worth 150,000. These are subject to corporate income tax. Dividends from shares of 50,000. These are exempt from corporate income tax. Gains from disposal of shares or bonds of 40,000, again exempt. And also bank interest income of 10,000, which is exempt from corporate income tax but is subject to special defense contribution, being of a passive nature. And finally, the company incurs the following annual expenses: external asset manager fees of 10,000, custodian bank fees of 10,000, fees paid to the ASP of 5,000, audit and accounting fees of 5,000, and bank interest expense of 40,000. Very important assumption that we are making is that the bonds of 3 million were financed partly from the bank loans 2 million and partly from own funds 1 million. Why is this important? Because the bank loans and the own funds were used to acquire an asset that generates taxable income. Therefore, the company can claim NID on the equity of 1 million because the coupons, the income of which is taxable, have been partially generated from the application of the new equity. And it can also deduct the interest expense on the bank loan. Why? Because the bank loan was used exclusively to acquire an income-generating asset with that income being taxable. If the loan or the equity were used to acquire assets that do not generate taxable income, for instance, for the acquisition of shares which generate dividends, it would not be possible to claim NID. It would not be possible to claim the bank interest expense as tax deductible. And finally, the calculation of the NID deduction. As I have said, this is by applying a reference rate to the equity that was used to acquire the bonds. The equity is worth 1 million. The reference rate, we are assuming that it was invested in the US, so we're using the US 10-year government bond, which currently is 1.9, plus the 5% margin, that gives us 6.919%. Applying this to the 1 million gives us a theoretical NID of 69,190 euros. However, as I have mentioned, this needs to be restricted to 80% of the income generated from the application of new equity. Now, 3 million worth of bonds, only 1 million was financed through own equity. So it's 1/3 of the coupons. 1/3 of the 150,000 restricted to 80% gives us a maximum of 40,000. So taking the lower of the two, the 69 and the 40, it means that in this case, we can only claim 40,000 as notional interest deduction. And moving on to our practical example, we have coupons from bonds worth 150,000. This is taxable. Dividends from the shares are tax exempt. Profits from the disposal of the shares or the bonds are also tax exempt. And the interest income from the bank deposits, this is exempt from corporate income tax, but it is subject to special defense contribution, as can be seen at the bottom of the page. Now, we are deducting 60% of the general expenses. Why is that? Because the company has taxable income of 150,000 and non-taxable income of 100,000, the dividends and the profits from disposal and the bank deposits. 150,000 out of a total of 250 is 60%. So we are restricting the general expenses to 60%. So we have 6,000 of external asset manager fees, 6,000 of custodian bank fees, 3,000 of ASP fees, and 3,000 of audit and accounting fees. The bank interest expense of 40,000 is claimed in its entirety because the bank loan was used exclusively to acquire bonds, the income from which is taxable. That is why we're claiming the entire amount in this case. So by deducting the taxable expenses from the taxable income, we get 92,000. We're also claiming the NID, which was analyzed in the previous slide, and this gives us a profit subject to corporate income tax of 52,000. By applying the rate of 12.5%, we get corporation tax of 6,500. Think about this for a minute. The company has total income of 250,000, and it only gets to pay corporate tax of 6.5. So the effective rate is a lot less than 12.5 because of all the tax deductions that we were able to claim and because of the NID. As for the bank interest income of 10,000, well, unfortunately, there is nothing to do to reduce this. It is taxed on a gross basis, subject to special defense contribution at the rate of 30%, which gives us 3,000. And a few words about the obligations of the company. Cyprus companies are obliged to submit income tax returns on an annual basis, and the deadline is 31st of March. Any tax remaining to be paid needs to be paid by the 1st of August of the year following the relevant tax year, but the company also needs to calculate and pay its tax through temporary installments during the same tax year. What it needs to do is to estimate its tax liability and pay it in 2 equal installments on the 31st of July and on the 31st of December of the same year. It is important to make your estimation with at least 75% accuracy. And this is in order to avoid any interest or penalties. I understand that in case of investment companies, this might be difficult, but every effort should be made to stay at least within the 75% rate for avoidance of penalties. After the temporary tax is paid, any tax that might remain can be paid until the 1st of August of the next year. And this concludes our presentation, which I hope was useful. Thank you very much for your time and attention.